Hey everyone, Tom Gentile. Welcome to Tom's Trading Essentials. This is week number 3, our third week. A lot of stuff. We had a lot of case studies in the last couple of weeks. A lot I want to cover with you. I've got my guest and trader Mike Wade on with us this evening. Mike, good evening.
Good evening, everybody. It's good to be here.
I am going to be checking back in with you in just a little while as you're going to be discussing trading delta neutral and trading earning strategy. It's going to be fantastic. We're excited to have you on here. We get Mike on here about once a year. He's a busy individual, but we also so the plan is tonight we're going to discuss the last couple weeks. I'm going to go through every case study. I want to show you every case study that we discussed in the last few weeks, and we're going to check in and see how they're doing. Winners, losers, the whole thing. We're also going to discuss earnings and how to trade in earning strategy non-directionally. It's a very, very cool way to trade. We got a ton of things to cover with you guys, but let me go ahead and start with this. The session is being recorded. All right, so those of you that are coming on board right now, we will get a recording to you as soon as possible following the live event. The second thing is that you can ask questions in the Q&A box. I can't guarantee I'm going to get to every one of them. In fact, I can probably guarantee I won't, because there's just so many people that are here when we do these Trading Essentials webinars. We open this up to our entire group, and those of you that are Optionetics students, you're entitled to this. Also, we're gonna, if you have questions, you can punch them in the Q&A box. Finally, disclaimer you see on the screen. You can read this from beginning to end, and you can do that by on the recording we have. Just pause it if you like. Couple things I want to point out. Stock and options trading has large potential rewards, but also large potential risk. The other thing I want to mention is that myself, Mike Wade, Jay, everyone associated with Optionetics and Tom's Trading Room, we are here as your educators. We are not personal investment advisors. We do not offer specific trading advice. You need a broker to trade with. You must meet certain requirements, and everything I'm going to talk about tonight, as well as Mike Wade, we are talking about these in US dollars unless noted otherwise. So let's get into it. All right. For those of you that, I mentioned this on week 1. I've been doing this now over 25 years, trading stocks, options, commodities, currencies. All of you know me as the co-founder of Optionetics, right? Some of you may not, but I was a co-founder of Optionetics with my friend, mentor George Fontenilles. We trained over 400,000 students since 1993. All right. What have I been doing lately? Well, one of the things that I do is I appear on CNBC. I've been on Bloomberg, Reuters, Fox Business, and more. I don't do those so much because they just take too much time out of my day. I will do them Skype, and I do them Skype. But any of the live stuff, unless I happen to be near a studio, I just won't do it. Some of you know me as a publisher, consultant. I provide content and research analysis to companies worldwide. And also, you probably know me as the founder and editor of TomGentile.com, Tom'sTradingRoom.com, and Tom'sOptionTools.com. Now, I'm going to start off talking about the biggest question that I got last week, and then I want to do a review of weeks 1 and 2. We got some homework and case studies that we talked about, and then also mastering the straddle through earnings season, and that's with Mike Wade. So, my biggest question I got last week is, why did you take back Optionetics? All right, I thought that was one that I needed to ask and answer to all of you here. So, as you know, we had Optionetics, and it ended up being merging with Options Express, which then got bought out by Charles Schwab. So I was actually a managing director of Charles Schwab for the time that we had that contract. Right, that contract came up. They didn't renew that contract. I was actually very happy that they didn't renew it, because then I could get back to doing what I really like doing, which is trading and then teaching a small group of people. But somewhere down the road, there was this discussion about getting Optionetics back, and I decided to go ahead and take back over Optionetics. Didn't need to do it. All right. Honestly, I did not. These guys that know me know I didn't need to do this. I did it because I wanted to. I did it because, there was a mutual feeling that I could do a better job with my small niche company than Schwab could. And nothing against Charles Schwab. It is a multi-billion-dollar company. They house over $1 trillion in assets. And so for something like Optionetics, when they bought Options Express, I always said it was kind of an adage that Optionetics was like that little free gift you get at the wedding. All right, when you go to a wedding, it's that little gift that sits in the middle of each table with your name on it. I'm not sure they knew what to do with it, but they found some great intellectual property. But upon talking with them and them talking with me, it just made sense that I could do a better job just because we have a more personalized service that we bring to the group. We're smaller than them, obviously, but we do offer the Trading Essentials webinars with the team. I got a lot of the team back together, and we also brought back live technical support right here with our group, which is something that's personal as well. So we're very excited about that. All right, and I'm also under contract with Schwab to handle outside the USA. So we contract through them to offer to the Optionetics seminars outside of the United States to folks outside. So we're excited to do that for them. Now, also, I want to let you know we do offer advanced seminars and premium software just like we did in the past to Optionetics students that want it. So that was kind of my question. Why did you take back Optionetics? I didn't need to do it, guys. I really didn't. My wife asked me quite often why I did it, and I think I kind of do it because for some reason I feel like that's what George would have wanted. So that's why we did it. So I ended up getting that back, and now me and Jay and the group are able to bring to you what we used to bring to you, and we're real excited about that. So let me do a quick little call and put review with you, and when I say quick, I mean real quick. You all know in week 1 we discussed calls and puts. Calls give you the right to buy, puts give you the right to sell if you're going to be long a call or long a put. All right, predetermined price, that's your risk. What you pay for a call option, that is your bottom line risk when you add commissions to that. And so keep those things in mind. That those are 2 of the easiest option trades to do. Maybe when I say easiest, I mean easiest in the execution. Maybe not the easiest in making money. All right, but we talked about calls, we talked about puts, we talked about some of our different trading strategies that we use, and we also discussed a number of trades as case studies in both week 1 and week 2. In week 1, we talked about Aetna. Symbol was AET, and we discussed the Aetna June 15th 175 call. All right, this at the time was trading for $4.39, and as of the close of today, that option is now up about $75 a contract. Okay, as you can see on the screen, you see the limited risk to the downside, all right, and you see the unlimited reward that happens to the upside, but it's only unlimited until June 15th is over, and that's coming up over the next week, all right. Next trade we discussed a call option in NetApp. Okay, so you can see at NetApp, symbol NTAP. We did this on week 1 as well. And we were looking at the June 66.5 calls. These were trading for $2.71. Look where they are now. They're at 750 by 765. So these are now up nearly a triple. And as you can see, here's where your risk is. Here's your break even. Here's where we are right now on this particular trade, close to the $500 level, based on where NetApp is. Yesterday, NetApp was even higher. We were up here on the graph, but it pulled back a little bit with the markets. They obviously pulled back today. All right. Also on the 24th, we discussed FLIR Systems, FLIR. We were talking about the June 15th 55 call. That was trading around 85 cents. And look where it is now, 60 by 75. So it's down. This one's down a little bit, but as you can see, the worst we can do is what we put on the trade, put the trade on for, which is 85 cents. That's the worst that you have as a call option buyer, is what you paid for the option. Obviously, we like to get this one moving, and it's down a little bit, but it's not down that much. All right, $17 per contract based on the mid quote. Now, last week we discussed we were doing a review of calls and puts, and we were talking about FXE. You guys remember that? We did a market outlook. We discussed FXE, and at the time we were talking about the July 20th, 111 calls, looking at a long-term view of FXE. This was trading at 225, and as you can see here, it's now 283 by 288, so it's up a little bit. All right, this one's moved up a little bit since last week. We also discussed the CVX. We talked about CVX. We talked about oil. We were talking about the need for a rebound in oil. And we were looking at CVX at the time. This was the July 20th, 125 call. They were trading at $3.38 on Wednesday. And of course, they flopped around a little bit, but today it got a big move up. And you can see now that 338 has become 450 by 465. So it's up about $120 per contract when you split the difference. All right, that's CVX. Now, I'm going to do a little review with you on call and put spreads. This is what we talked about last week. So if you remember, the difference between a call and a call spread is that a call, you're simply buying a strike. A spread means you're buying a lower strike and selling a higher strike with calls, right? So we call it a bull call spread. And we do that buying the lower, selling the higher, because what it does is it lowers the overall cost of the trade. It lowers the overall risk in the trade, and it also lowers the fluctuation, which can sometimes be a good thing. Most of the time it can be a good thing. Sometimes it can be a bad thing, all right, when you look at both of these. I'm going to show you an example of each because we had, over the last couple of weeks, we had three case studies involving spreads, all right? This is the example we used looking at a risk graph, that if you bought an XYZ 100-120 spread and you paid $5 or $500 for it, then you would have $500 of risk, but then $1,500 of reward. And that's because you're looking at the difference between what you bought and what you sold. That's 20 points. You paid 5 to take the 20-point spread. All right, so 20 minus 5 is 15, and that's how you come up with your reward. Now, this is where software and even your broker site can help you determine these risks and rewards. All right. Put spreads are just like call spreads. We discussed the fact that put spreads are used in bearish opportunities when options are expensive. You buy the higher strike put, you sell the lower strike put. And it also has a lower cost, a higher reward, and a higher profit potential. Now, the case studies we discussed last week were in CVX. Remember, we talked about CVX and we discussed a comparison between the CVX call and the CVX call spread. We also did one on Amazon because that's one of the most expensive stocks out there, and how to take a $1,600 stock and do it for less than $500. And then we looked at a put spread using UAL, United Airlines. So let's take a look at each. Now here's the CVX spread. The CVX spread was the 125 call, 130 call. This is a bull call spread. Buy the 125, sell the 130. So if you remember, the 125 calls on their own were 338. But when you do the spread, you're subtracting $1.42 from the 338. So you can see here that you've got a risk of just over $200 risk. You have a maximum reward potential of near 300. So this has a reward to risk ratio that's greater than 1 to 1, right? So taking a look at this one, you can get an idea, and I'll show you what this looks like as we go through it and as we look at this. But this is an example of what that trade looks like, all right? Here is the Amazon trade. By the way, the CVX trade went up, but this is the one I really want to show you, all right? Amazon. We looked at now remember, Amazon was trading down around the 1620 area last week, and we were looking at the 1680, 700, 1700. So the 1680s, remember, they were trading for 605, the 1700s were trading for 305. This was a 20-point spread that you could do for $3 or $300 for the spread. I remember emphasizing this last week, saying that we were looking at that XYZ for 500, and that you could find spreads, 20-point spreads for less than $500. We found one for 300. Now, where has it gone since? This one's gone bananas because, again, if you've been following Amazon, Amazon took off like Justified did coming out of the Belmont stakes. All right, came out like crazy. In fact, I'm thinking of the Preakness. I'm looking forward to Belmont this weekend. but came out really good, really strong, and it followed very strong. Even today, even when it fell down, it gained back a lot of what it lost today to still be very close to the highs. But I want to show you what the spread looks like. So that $6 call is right now bidding 25.65 by 26.25. That is huge. That is huge. That's a 400% better than a 400% return on the calls. All right. But now look at the calls that you sold. All right. Hey, if we could go back go back to last week and just buy the 1,700 calls for $3.05, they would have been worth $15.35 today. That's a 5 times return on investment, 500% return in 1 week. It doesn't work like that all the time, guys. I mean, this is something that, we saw this, we saw the pattern, we were looking at money counter, we had a lot of things going for us on it, but it doesn't always happen like this. It just so happened that this one was, if you look at that chart, 1, 2, and then 3 times it crushed it right through. And so that's what ended up happening here. We had a crush through, great trade, fantastic trade, but this was a 3-point trade that actually expanded out to be greater than 12 points. So this was a 400% return. 300% return just on the spread itself. Now this is a put spread. This was UAL. Now I want you to look at UAL. So with UAL, we were looking at a bearish trade, buying the 72 puts and selling the 67s. We discussed this last week as well. The 72s were trading for 365. The 67s were 131. Look what happened in the last week. So UAL ended up dropping on that Delta outlook where things were not going to look so rosy. Delta got crushed yesterday. UAL fell down with it, but then it rose right back. But then it fell down again today. All right, so it's kind of been off and on. We're pretty close to where we were last week, but look what's happened. The 72 puts have dropped a little bit. The 67 puts put money in our pocket. So we're up a couple dollars on the trade. All right. So when you look at all of our case studies, we are looking at calls on Aetna, calls on Fluor, calls on NTAP, calls on FXE, calls on Chevron, call spreads on Chevron, call spreads on Amazon, and put spreads on UAL. These are all the case studies that we discussed over the last few weeks with our Essentials trading class, right? So how are they doing? Well, in our software, we have the ability to go in and create portfolios. And this is a portfolio that we did for Tom's Trading Essentials, the May-June portfolio for 2018. This is one contract of each. This is not even optimized for money management, all right? This is just looking at a one-to-one contract. If we optimize this for money management, we would have taken more of certain trades and less of others based on their cost. But just looking at one contract of each, you can see here, this as you can see here, you can see the Aetna trade. The highest it did was $176. The lowest it did was a minus 127. Right now it's up $74. So it shows your best day, your worst day, and today. All right, so up 74, Fluor down 17. This is NTAP up 487. This is Amazon up 737. FXE is up $61. The CVX call is up 120. The CVX call spread is up 60, and the UAL trade is only up $4. So 7-1, 7 winners right now, 1 loser. Total gains 1543. All right. So this looks really good. The ratio of gains to losses is 90.8 to 1. All right, largest gain, 737. Largest loss, $17. It's been very, very good for this particular Trading Essentials class, as we've shown you, again, rules-based trading, how we trade, etc. All we did, folks, was we spotted the opportunity. We use different systems and strategies to do that. All right, we talked about darknet a little bit. We talked about the money calendar a little bit. But then it comes down to creating that low-risk trade. And you create that trade that makes sense to you. And I said, look for, based on whatever trading system you do, you look for what's my price target and what's my time frame. And that helps you create the option or the option spread. Then it's a matter of planning, executing, and managing. All right, when I plan the trade, I look at steps 1 and 2. Executing it, I make sure that, a lot of times I use limit orders. Unless it's really, really liquid, I'll use limit orders, and I know you can't get right down the middle, but sometimes I can. but I don't usually like to go right at the market. And I'll have an exit plan. So as soon as I put that order in, my exit plan is get out of half of it when it doubles in value and have a target plan for the rest. So at this point, Jay, are there any questions about what we've covered in the last couple of weeks before I turn this over to Mr. Delta Neutral?
Well, you covered a spread case study, I think, but Mark was asking if our services do use spreads over calls and puts.
Say that again. Do I spread over calls and puts?
Do we use spreads over calls and puts? Maybe not over, but in conjunction with.
A lot of times I do. Okay, so I mean, if both of them, like the CVX trade, I showed the CVX trade that was under $500. All right, but the spread also looked good too. If CVX is moving like the oil market's moving right now, there's a pattern we discussed in oil. I'm more than likely to just put the calls on. But if we're in an area where the market's very choppy, and it has been choppy for us lately, but if we get choppy or if we get into an area where we have a lot of bearish sentiment, bearish seasonality, then more than likely I'm going to go with a spread. If the stock is an expensive stock like Amazon, Priceline, Booking, any of those stocks, then I'm more than likely going to spread because there's no way I'm going to get something that I like for less than $500. Okay, so hopefully that answers the question. Now, let me do this. Let me turn this now over to Mike Wade. He has got a fantastic few minutes he wants to spend with you. Well, more than a few minutes. He's going to talk about straddles. He's going to talk about how to get into straddles. Before I turn this over to you, Mike, in fact, I'm going to do it before I do this. Let me share. I've got a question I want to ask everyone. We've done these for the last couple weeks, and I have a polling question. I want to poll all of our Optionetics students, and let me grab that poll right now. I've got it in here. This is something that I thought about as I'm looking at this, and I'm looking at the incredible case studies that we've shown in the last couple weeks. And I decided, what? I want to ask everyone a question. Here's my question to you. All right. My question is, what are the biggest obstacles that are keeping you from hitting your goals as a trader? All right. I want you to select one of these. It's either lack of knowledge, lack of time is one, lack of discipline, all of the above, or I'm hitting my goals as a trader. Okay. And like I said, this is, we're not collecting this, this isn't like Cambridge Analytica where we're collecting all your data. I don't know who's answering these. What we're getting is a poll. And the poll doesn't give me your name. It doesn't give me that information. What it does is it just gives me your answer. And then we're going to show all the answers on the screen. So once again, what are your biggest obstacles from hitting your goals as a trader? Lack of knowledge, lack of time, lack of discipline, all of the above, or I'm hitting my goals as a trader. All right. I'm going to close the poll.
And let them know to click the buttons. They're typing in the Q&A.
You can't do both of them. Just no typing in. Just click one of the buttons and click submit. All right. When you do that, then that gives me your answer. So I'm going to 5, 4, 3, 2, 1. Let me close the poll. All right, so I'm going to share the results with everyone. And I just want to talk about these for a little bit. So lack of knowledge. Well, you know what? Hopefully what it is that we do here, because we do Chomps Trading Essentials on a regular basis. And we'll talk about calls, we'll talk about puts, we'll talk about spreads, and then we hit on something different for the quarter. All right. And tonight we're going to be talking about straddles. Okay, so hopefully we can start to give you some knowledge on how we do this. All right, lack of time, that's a big one. All right, and so when I think of lack of time, I think about how I would go through and try to find these rules-based trades that I have, and now we're going to show you something tonight that just makes it so much more efficient and cuts down the time drastically. All right. Lack of discipline, that takes experience. And as you find knowledge and as you find the time through efficiency, your discipline should improve. All right. The biggest one I see is all of the above, and we're hoping that we can help you with all of the above. And that 5% that are saying I'm hitting my goals as a trader, there's several of you in this room that have been with us for a long time here at Tom's Trading Room and Optionetics, and hopefully a lot of the stuff that we're doing, whether it's here in the Trading Essentials or if it's in some of our advanced classes or using our software, it's helping you hit your goals as a trader. We hope that's the case. So at this point, what I want to do is I'm going to get rid of this screen, and I want to now turn this over to Mike Wade. Mike, are you there? Are you ready?
I'm ready, Tom. Ready
All right,
to go.
you now have the con.
Okay, great. Can you see my screen?
And all you got to do now, we can see you. All you got to do is just push that. There you go.
Okay.
You can begin.
Great. Well, welcome everybody. It's really, really great for me to be in a room, although it's electronic, with you all. I know I've taught many of you and been in rooms with you and webinars with you, and I do miss those days. And I've got a lot of great memories, a lot of good friendships that's come out of teaching with Optionetics and teaching with Tom. So I've been doing this trading gig since 1998, when I quit my corporate job and began trading, dare I say it, naked puts back in 1998, and all the way through the first part of 2000, first couple of years of 2000. And then I got in, of course I lost a little bit of money in 2000, but I always loved to sell options because of the premium, the probability that comes along with being a seller. But being a seller also comes along with being taking on a lot of risk. So over the years, maybe it's because I've matured, Tom, but over the years I have developed less of an appetite for risk. So one of the things I wanted to do, and I believe I've done over the past, how long have I been teaching? 16 years with Tom and Optionetics. I've been teaching a long time, and I really care about students, and I know that some struggle, some do well, and some take it on. And I really was on the lookout for a strategy and a system that worked greater than 50% of the time, where the average win was bigger than the average loser, and generated profits, and was simple and required knowledge, but not a lot of in-depth knowledge. So that's what I've created, and I've been at this system for about teaching it for about 3 years now, and I'll share it with you here in a few minutes. So I'm gonna we've already looked at the market outlook. I know you've seen that already, but what I want to talk about is how we can use earnings as a catalyst and find patterns with 100% historical accuracy, regardless of market direction. All right, so trading for Tom and me and Jay is all about finding historic patterns that tend to repeat, and then trading those patterns into the future. So really what we have as a trader is we're looking into the future, trying to predict what's going to happen next. Is the stock going to go up? Is it going to go down? Is it going to go sideways? Is it going to gap? And then what do I do with that information? And how do I know that history is going to repeat? So what we recommend that you do to test your skills is to do back testing, and to find a system that has really, really good historical accuracy, and then trade it into the future. Well, we found a pattern. I'll show it to you in just a second. My favorite pattern on the planet when it comes to trading, and how we've been able, with the power of Tom's tools, to do historic back testing in the button and actually present to you great short-term straddles that usually within 10 days or so, we're in an average of 10 days, sometimes only a couple of days, but finding these short-term trades that have very limited risk and really nice return, and they're easy. So that's what we have in store for you tonight. These trades can cost as low as a few $100s. Some of them can cost thousands of dollars. When I trade, I'm typically trading for my classes in the 2,000 or less range, but that's oftentimes multiple contracts. So you don't need a lot of money. That's the point. So that's what we have on tap for tonight. And feel free to ask questions, of course, of Jay. He's sitting in the sidelines, and we'll take questions at the end as well. So Tom just did a really good job of going through. By the way, Tom, congratulations. 6 out of 7 isn't too bad. I think you did all right there.
7 out of 8, but who's counting?
I don't even know what that is. That 85% or something? That's fantastic. All right. Here's a risk graph of a long call. This is a modern risk graph, and what the risk graph does is tell you how much money you're going to make over time and price. So if the stock goes up to 29.8, you're going to make something like $350. There's 29.8. You're going to make about 350 bucks. All right. So that's a call option, not without risk. It only makes money if the stock price goes up. It loses money if the stock drops. All right. So that's a call risk graph. A put risk graph, flip it upside down, same story, except the put only makes money if the stock drops, and that's it. Now, one thing to keep in mind is if the stock does nothing, what happens to the value of your option, whether it be a call or a put? And the answer to that lies here in these colored lines. As time ticks away, it's like you have a timer, an expiration date, like milk. Over time, the time value in the option actually ekes out. So that's a risk when you buy an option. All right, that's really important to note. Now, why not trade both ways? Why not buy a call and a put together? Okay, we call that a long straddle, and it's done in the same trade as a package. You buy a call and a put at the same strike price with the same expiration date. The benefit of this is that there is really no directional risk other than the stock not move. If the stock moves, perfect. If the stock stays the same, there is risk, and we'll talk about that in just a minute. So if we turn that long call, this long call, into a straddle, it would look remarkably like that. All right, so now you have a risk graph where if the stock goes up, you make money. That's good. You make more money on the call options. This is the call. You make more money on the call options than you lose on the puts. So if the stock goes up, happy, happy. If the stock drops, the puts make money and more money than the calls lose. All right, so this is what's beautiful about a straddle. You don't have to really worry about what's going on with the stock. You're not going to wake up with a big gap and be unhappy about it. Usually you're going to be very happy if the stock moves. The stock moves, that's good. Now, what happens if the stock doesn't move though? And that's the risk I was talking about before. The risk of a straddle, as you can see here, is we bought a call and we bought a put. We doubled down basically on what we bought, and now our time decay risk is doubled. All right, so this is one of the reasons that people stay away from straddles. It's that they're time decay risk, but there's others. Let's do a little poll here, and you can just type it in the Q&A box. But what do you think are the biggest risks to straddle traders? What are they? When you put on a straddle, it's really great because you have no directional risk, and if the stock moves during the life of the trade, you're probably going to be happy. You're probably going to make money, and you could make a lot of money. But there are risks. I mentioned one of them. But what are the risks of trading a straddle? And Jay, as they come in, just fire them at me. See if we get some good answers here. Stock moves, that's good.
Most of it's coming in as time decay, theta decay.
Time decay and theta decay, very good. So
and volatility loss.
You got them all. Beautiful, really great. So there's really all three risks. Now, with a straddle, if the stock doesn't move, that's a problem. All right, if the stock doesn't move, then that's going to kick in your time decay risk. So time is going to be working against you while you're in the straddle. If the stock doesn't move, these two together, delta and theta we'll call them, or directional and time risk, call them what you want. That's the Greek version, same thing. But those two together means that you're going to be losing a bit of money every day, okay? And then there's the volatility risk, and we measure volatility risk with the Greek called vega. Don't worry about vega, it's volatility risk. If the implied volatility were to drop during the life of your straddle, then that could lose you money as well. So volatility is a really big one. It's one that's not well understood by many, many option traders. Optionetics, we know about it, we teach it, but there's a host of option traders that trade straddles and don't know anything about volatility risk. Now, that is a key one, particularly if you hold a straddle over an earnings announcement in order to catch a gap, in order to really go for the fences, so to speak, baseball analogy, then you'll get crushed. If the stock doesn't move, you could lose a great deal of your straddle's value. So there's risk there. And for that reason, it's pretty common for a lot of option traders to stay away from straddles. And I was one of them. I didn't touch straddles. They cost too much money. I had to wait too much time. And if the stock didn't gap, then which wasn't always, if it did gap, it didn't gap enough. And I found that I wasn't, my hit rate on a straddle, my win percentage was, I would say, probably something like 1 out of 3, maybe even less than that. So straddles are typically kind of like not really played around with too much. Now I'm here to change that tonight.
Hey, Mike.
Yes, go ahead.
Also, I just want to interrupt you a second and let you know that when you're about to discuss earnings, I actually have a poll for you that you can ask the group.
Okay, great. Yeah, I'd like that.
So let me know when you want me to throw that up on the screen, and I will.
Okay, let's do it now.
Okay, so this is actually something about that's a poll based on straddles. So let me throw them up there so you can get an idea real quick. As a group, how do you know about straddles, or do you know about them? Have you ever traded them before? Never heard of them, never traded them, know them enough to be dangerous. I trade them often and I love them. So your poll is being is out there right now. Please vote. You can pick one of these and then click on submit, and we will grab your answers here in just a few more seconds. And again, like I said before, your name is not shown on the quick poll. All we do is we grab everybody's answers and we put them all together to show everyone in the group what the group picked as a group. So, all right, 5, 4, 3, 2, 1, and let's close the poll. And Mike, here are the results.
Wow, I'm a little, actually, you know what? I was going to say I'm a little surprised. 10% never heard of them. I get that. That makes sense. Never heard of them and never traded them. That makes sense too. About almost 60% of you have never heard of them, never traded them. They know about them but don't trade them, probably because of the reasons that we just spoke about, right? They're expensive. Time works against you. Volatility goes the wrong way, particularly after the announcement. You're going to get crushed. Stock doesn't move enough. You're going to lose money. 1 out of 3 is kind of the industry hit rate. You win 1 out of 3. The 27% of you that are there have probably traded them and had some bad experiences. Obviously, you consider them to be dangerous, probably because of what I just mentioned. If the stock doesn't gap enough, the IV will crush you the next day. As soon as the earnings announcement's out, then IV comes out. It's kind of like ticket scalping at the Super Bowl. As soon as the Super Bowl, the kickoff happens, the ticket prices that were $1,000 are now down to 500 minutes after the kickoff. And then I'm really happy about the 5% of you trade them and love them. And I know that if you're doing that, it's probably because you have a really good system. You probably have a stable of stocks that you've traded month or quarter to quarter. You might even be using the system that I'm about to share with you. All right, good poll, Tom. Thank you. All right, it's always good to learn what's going on with the audience. All right, so I kind of forecasted this, but we're going to talk about what we're going to call an earnings scalp. So we're looking for a pattern. We're looking for a repeatable pattern, and this repeatable pattern that's consistent and reliably, historically, is generated from an earnings announcement. All right. So this has taken us years to develop, and I mean it. I started talking to one of the other Optionetics traders about this system about 10 years ago. And he was doing all this arduous back testing, and he found like 2 or 3 stocks, and he'd go back 8 earnings periods, and he'd try different days to get in and get out before the earnings announcement and scalp, basically. And it was hard, and it was a lot of back testing work, and it didn't work all the time. or as much as I wanted it to. So this has been developed, and the system is really simple once I explain it to you, but it's similar to a ticket scalper, as I said. So what happens is, before an earnings announcement, what happens is the volatility spikes up. So this pattern that I'll highlight here in a second is what we're going to trade. This is the sexy pattern that we're going to use to scalp implied volatility rush, in essence. So each earnings season, what we do is we run our scans and we find the very best opportunities to take advantage of the rush in implied volatility without going after the price movement. So we're really putting on a trade where we make money even if the stock doesn't move, and if it does move, we make more money. And we repeat that. This system is about making money even if the stock doesn't move with a straddle. Okay, with a straddle, time passes, volatility rushes in and offsets time decay, and we make money even if the stock doesn't move. And if it moves, we make more, like icing on the cake. Now think about that for a second. Without knowing what that is, would that be something you'd be interested in? Putting on a 10-day trade, put it on 10 days before the earnings announcement, and the stock doesn't go anywhere. Maybe it does, but even if it doesn't, you're going to make money, historically speaking, as you approach the earnings announcement, and then you get out before the announcement and take your trade off without risking implied volatility crush. All right, that's what we're talking about tonight. This is what's so different about what we do. I don't know anybody else that trades straddles like this anywhere. It is a system that we keep proprietary to our students, and both Tom and myself and Jay, everybody's trading it because it works. Okay, so earnings announcements, if you're trading just calls and puts, are frustrating for most and profitable for a few. All right, so what's important to note about earnings announcements is that you just don't know which way the stock's going to go. All right, so this is Amazon. It's an older chart of Amazon, but you can see Amazon gaps down sometimes, gaps up sometimes, and so you can't predict with a directional trade with any reliability by using calls and puts. You just can't do it. Good news doesn't always lead to higher prices. Here's Green Mountain Coffee with a whole slew of good news as the stock gaps down each earnings announcement. All right, so this is treachery for most, but opportunity for us, for the reason I'll show you in a second. Here's another one that went down on 4 positive earnings announcements. SanDisk tanked each time the earnings came out. All right, so this is a pattern, right? It's a repeatable pattern. SanDisk, Green Mountain Coffee, Amazon, three of many stocks that gap at earnings. All right, so that's a pattern. It's reliable, and the pattern is reliable, but trading it with a straddle is not reliable enough. All right, not to worry. You're with Tom and me and Jay. We've got it figured out, and this is it: the power of implied volatility. The few who understand it profit from it. And again, as I said earlier, most people do not understand this chart right here. Okay, so this is the implied volatility chart. Don't get if you're new or maybe just getting back into the trading world, please don't get concerned about terminology. All this is these colored lines here are how expensive the options are based on how much the demand fluctuates. That's it. It's another way to think of implied volatility is demand. So think about, when would options be high in demand? All right, think about that for a second. And if you're an option trader and you happen to know that SanDisk or Green Mountain Coffee in this case gaps at an earnings announcement, all right, now you don't even know about this, what's underneath the covers here. You don't know that options are priced more expensively. As the demand increases for the options, as you're approaching the earnings announcement, option traders are coming in buying straddles most likely, or maybe even they're betting directionally. They're willing to pay more and more and more and more right before the event, right before the kickoff. They're willing to pay $5,000 for their ticket to get into the game. And the next day, they're counting on the stock gapping enough. All right. So the next day, what happens is the stock's either going to gap a lot, gap a little bit, or not gap, and probably give you at best a 1 out of 3 chance of making some kind of money on a straddle. So what we want to do is we want to get in on this red wave here, and we want to figure out when to get in, and we will get out before the earnings announcement. All right. So all we want to do is ride this red wave. We got to figure out when to get in though, and that's the trick. I'll show you how we do that. But think about it. You're going to get in, you're going to buy tickets before they get super expensive, and then you're going to get out before the game starts. You're going to rescalp your ticket. You're going to sell your tickets off. It's kind of like that. It's kind of like a ticket scalping game that we're playing. So this pattern is without a doubt my favorite pattern. It's the most reliable pattern that I know of. It's repeatable. You can make money on it. You know that it's going to happen next time, most likely. At some point, they start to change, but these patterns continue. They're reliable. You know the IV is going to rush in before the earnings announcement on Green Mountain because people want the options, because the stock gaps. That is the system. So you'll notice that Green Mountain, I just said all this, so I'm not going to say it again, but this doesn't just happen on Green Mountain. It happens on Amazon. Right into the earnings announcement, you get the IV spike, the demand spike. Let's keep it easy for those that are new. It's the demand spike. Options get more expensive. We buy them when they're cheaper, and we sell them when they're super expensive, and then they drop to earth the next day. That's the game. SanDisk, same deal. All right. So what's the system? Once again, a little more graphic, just so you really get it. So the idea is that we come in before the earnings announcement. We'll buy, now check this out, you might fall off your seats. We might even, and most often, buy weekly options and hold them until expiration. What? Yes, we hold weekly options and we hold them to the expiration date. They might even have one day of time left in them when we get out. So we're even using short-term options, which reduces the cost of them, of course. So we're going to hop in. We got to figure out when the green light is, what time, how many days before the announcement. We'll figure that out, show you how we do that. And then we get out before the earnings announcement, avoiding any IV crush. And guess what we do the next earnings announcement? Oh, we just do it again. And the next one, every 3 months, same thing. Enter, exit, enter, exit, enter, exit before the earnings announcement. So this is the system, and it is. I'm going to come back to this in a minute. I want to show you an example of how this works, and I'm going to try to not make it too complicated because there's a lot I could show you here. I'm going to show you a couple things. This is a trade that we did last year in one of my publications. And these are common. It's not unusual to see a trade like this, but this is a short-term straddle on Snap-on Tools. Okay, so we got into this straddle. We bought a call and a put at 150 strike. And look at this. How many days do we have before expiration? 9 days. We bought a 9-day option, and we did that to maximize the IV rush. And then we got in 8 days before the earnings announcement, which means that at the earnings announcement we only have 1 day of time left. All right. If I go down to the IV chart, and I've got them colored differently, but you can see. I want you to keep an eye on this. You can see that the IV for these particular options is already starting to get more expensive. So as the line goes up, options are becoming more expensive. They're already becoming more expensive. They're more expensive than they normally are. But I know that earnings is coming up in 8 days. And I know between now and 8 days, history repeating itself, that these options will be even more expensive. All right. So that's the trade. We got in for one contract cost us $720. You can get in for less than that depending on the stock. Remember, we're using weekly options and they're cheaper. So with this system, we can get in a lot cheaper. And this is what happened 8 days later. Okay, this is a trade. we made, Tom, we made 31% in 8 days. I think that's what, 8 divided 3, 4, that's about 3.5% a day on this one particular trade. And what's sexy about it is this. Notice that the stock did actually move a little bit. Okay, we started here and the stock moved up a little bit and that gave us a bit of money. But some of you can see this and some of you may not be quite cognizant of what this is yet. But what happened is the IV rushed up so much. Look how much it rushed up. We started here and it's almost off the charts. The IV just exploded. And what that did is it pushed the colored lines, the expense of the options so much that there was no way for us to lose money on this trade. The bulk of what we made on this trade was IV rushing in and pushing this profit line, which is the today line. This is the line when we exited, and pushed this the theta line into profit. No way to lose money on this trade.
And Mike, let me remind everybody what it is you're doing here. Mike is not trading price, okay? When you look at price when you're going into a straddle, most people that have ever traded straddles before, that's what they think of. They think, oh, you know what? I'm not bullish or bearish on both, but the biggest risk is that it just moves back and forth and it drops. It drops down. What Mike has found is a pattern that happens. We like to say it happens 4 times a year, but it may not happen it doesn't happen on every single stock. Every stock has a different fingerprint, and each fingerprint will give us an idea of what stocks move the most in terms of people rushing in, buying calls and puts at the same time together and pushing that up. It's kind of like if you remember Beanie Babies back in the day. This is a piece of cotton that was sewed together with a piece of cloth and maybe a couple buttons put on the end for eyes. And this worthless piece of cotton with cloth around it was going for, in some cases, $5,000 before all the gas got let out of it. This is a pair of Super Bowl tickets that a year before the game, before anyone even knows who's playing in the game, it's worth one thing. And then 5 minutes to kickoff, it's worth something completely different. And yet, as soon as kickoff happens, the event is on and it drops in value. You're not basically trading on price. You're trading on the angst of all of these people rushing in because they think that this particular stock is going to go up huge or going to go down huge once the volatility or the earnings are known. And so we like to say buy before the rumor and sell before the news, and that's exactly what the strategy employs.
Exactly. Yeah, well said, Tom. That's a good way, another way to distinguish it. But I want to show you this just to punctuate what Tom just said. It's in the graph. This red line, when the IV rushes in, usually the red line, which is your profit line, will drop again to expiration. What happens is that it gets pushed into profit. It gets pushed over. And if that doesn't make sense to you right now, it will. With a little bit of practice, it'll make sense. But just think of it this way. Tom just said it. I'll say it one more time. I just love this way of profiting and trading. For me, it's the best. I just love it. And you're making money on demand. As the angst comes in or the demand comes in, it doesn't really matter what happens with the stock. We're just trading demand. And that's what's so sexy about it. So I've just given you a live example. I got you into the tool a little bit. You've seen Tom's tools. These are just some of the examples that I published over the last handful of months. I publish a yearly Straddle Red Wave publication, and we publish these trades. And I'm going to show you the results of the last 12 months in just a minute. But this is typical. These are some of the trades that we put on. You can see Kroger, Snap-on, some of these companies that double IV V1 26. I've never traded them before outside of a straddle. Hologics, and then others. But you can see here that the number of days in the trades are very, very small. They're all less than 10 in this case. Some are going to be more than 10, and some are even going to be 1 or 2. But notice the return on investment for a handful of days. All right, 31% over 7 days. You're losing 6% over 7 days, 33% over 9 days, 28% over 7 days, 31% over 3 days. And one of the things you'll notice about this system is that when you win bigger than than how much you lose. So I'll give you a month-by-month breakdown in just a sec. So, these are just some of them. On October 11th, we entered Snap-on. 7 days later, we sold it for 31%. On October 23rd of last year, we entered II6, and we exited for a 6% loss. Hologic, October 30th on Halloween, 9 days later, 39% profit. So imagine pulling in these kinds of profits with a smattering of losses over the same approximate time frame that are much less. Pure Storage, we exited 7 days later for 28%, and then 31% on CalAmp after 3 days trade on that one. Okay, so this is the annual performance for the last 12 months. I ended this in May. May was the last month, and this breaks it down through May through April. Actually, April was the last month, excuse me, and we started in May. So notice on the right, this is really what I want to start you on. Notice how many winning months we had. All right. So this is the balance of all the trades. When we won, we're on averaging somewhere in the 12 to 13 or so % range, and then when we're losing less than 10%. So you'll see the return. The more winners than losers shows up in a lot of ways. We generated on our account about 11,000. Now I position size this down to smaller trade sizes, so your return will be whatever you decide to invest. But this was on smaller size trades, just so people could get in. Notice in this case, our average win over the balance of the year was 2 to 1, basically. So our winners are twice the size of our losers. We had over 50% winners, 56% winners. You do the math there, that's always going to generate profit. So we made money, and our annualized return on investment, this was difficult to calculate because on these trades, because you're in the trade only 10 days or so on average, sometimes longer, sometimes less. It's not like your money's tied up for the whole year. There was a couple of months where we had a larger number of trades, like November. And so what I did is I calculated how much it would cost to handle 14 trades in November, although they all didn't overlap, and generated my return on investment, just so I could be conservative with you. The truth of the matter is, though, the return on investment is actually higher than 40. Would have been higher than 43% had I actually averaged it out over what would actually be required for me to take the trades and account for the overlap. But that's a conservative figure, and for anybody to say 43% is a conservative figure, that's pretty extraordinary, I think. So that's what we've done. Year before, same basic returns, same basic performance. And so how do we do it? Well, we have buttons. All right, not surprising. So we've built some buttons that go out and crunch data and look brute force over up to 10 earnings season and find stocks who have this pattern that consistently generate a positive return, 100%. All right, so imagine being able to go back to every stock in the S&P 500 or the Russell 2000 for that matter. Let's say we'll start with 500 stocks, and I want you to check 8 earnings periods, and I want you to check 30 days before the entry, a possible entry before the earnings announcement. Imagine the amount of number crunching that has to take place. So this button does historic back testing. It just says brute force. Let me figure this out. Let me try every day, 1 month before the earnings announcement for each stock over up to 10 earnings periods. And I'll tell you mathematically which day is the best day for you to get into this straddle on Snap-on tools, for example. In our case, what was it, 8 days? 8 days, it said 8 days for Snap-on. How do we know it was 8 days? Because it did all this work for us. and you get access to it by simply pressing a button. This is a system that I actually started working on a long time ago. And I worked with the developers, Tom's developers, and we systematized it and built this amazing button. All right, now I'm going to give you one to play with between for June. So here's a trade that's come up from the scanners. This is a result from the scanner, and what it's telling us is there's a straddle opportunity on paychecks. All right, so what comes back from the scanner is, when do you get in? All right, now notice also that it's looked, in this case, we looked over the last 4 earnings periods. If you look over the last 4 earnings periods, it's going to tell you that it would behoove you, the best entry date before the earnings announcement is 16 calendar days before earnings. It knows that only because it's done all the number crunching. It's tried every date 1 month before, and it did the math, and it figured out that if you get in 16 days before, on, in this case, 6/12, and you exit before the earnings announcement, you're going to have a historically, that was a 100% win, and the average return on investment for all of the 4 of those trades combined, the average of those 4 trades is a 25% return. So what you have here is a solid entry date, discrete, black and white, nothing to question, no subjectivity. It's brute force probability math. If history repeats itself and you get in on the 12th, 16 days before the earnings announcement, and you get out when we say to get out, then history repeats itself and you have a 25% return on investment for a 16-day trade in this case. All right, so this is a paper trade. I really encourage you to try this out. So what you do is you buy a straddle, and you want to buy an at-the-money straddle. Let me give you the details here. And you have the recording, but you might write this down or take note of. It's now we're now 1 hour into the 1 hour and 1 minute into the webinar. So if you want to time stamp it, you can come back to this point in the video. But the entry date is June the 12th, which is coming up next week on Tuesday, actually. And you want to buy to open the paycheck July W3, week 3, 2018 at the money straddle. Now, I don't know what the strike price needs to be. It'll depend upon where the strike is, the stock price is, I should say, in the last hour of the trading day. All right, so do it in the last hour, 3 o'clock Eastern. Start looking, put your order in, and again, I want you. If you haven't done these before, I'd recommend. I'm not going to recommend that you trade any real money at all. But I would recommend that you, at the very least, paper trade this, okay? And then what do? Well, you wait patiently if you want, although you don't have to be patient. You wait till June the 27th, and then you sell that straddle during the last hour of the day. 3 o'clock hits, you might start putting in limit orders to sell it for well within the natural bid-ask spread, but sell it. By 4 o'clock, you must be out of the trade, no matter what, by the last hour of the day on June the 27th. All right, so there's something to play with, just so you can get a taste of what this stuff's about. I also, you're going to find out that I just want to show you what I'm looking at for the upcoming earnings season. We're kind of in it, right? It's June, and we're going to start seeing earnings announcements coming up. Even more than are right now. So I want to just show you what I'm looking at for the next month or so. And what I'm really excited about is the returns on investment that are available. These are all the same type of trades I was talking about. They're straddles. I have entry date and exit dates for all of them. All of them have 100% win rates. And you can see here 79%, 33%, 53%, 47%, 36% historic 100% winners over 4 earnings periods at very, very high historic returns on investment. So I'm definitely excited about this coming up earnings season. And if you decide to hang out with me and have me teaching you this stuff, which is a possibility, then you'll be seeing these as well. So what I'd like to do before I hand it back to Tom is to get some questions.
Mike, real quick, why do you say the week 3 July options when you exit on June 27th?
Oh, Jay, I'm sorry, I didn't hear you, buddy.
Okay. Why get the week 3 July options when you're exiting on June 27th?
Ooh, I know the answer to that one.
Go ahead.
Ooh, pick me, Mike.
All right, go ahead, Tom.
Because Paycheck doesn't have weekly options. Some of these options, the best you can do is the week 3 option that comes up, or the monthly option as it's called.
Yeah, that's right.
More
That's the
often than not, you will probably have weekly options, but every once in a while, you come across one that doesn't have it.
Paychecks needs to come up in the times, man. They're behind times.
It does.
Thank you very much.
Any other questions?
Is there a way to do straddles other than just around earnings season?
Yes, but I wouldn't do it myself. There's not enough probability in it for me. You know, you can look at Bollinger Band squeeze patterns and triangles and pennants, and people do okay with that. But it's not as strong enough of a catalyst for me. And I, even with an earnings period where I know the earnings announcement where I know the stock gaps, it's still risky to hold over. It's got to gap a lot in order to offset IV rush or crush. So I wouldn't do it. I would not do it. I don't do it. I do it this way. This is smarter.
Thank you, sir. And you've already answered this. You've shown them the button, and they're asking, is there a way to scan, what's the best stock for this, what the stocks do traditionally around their earnings and such. But is there a way to find out when the earnings are going to be announced, when a stock is going to announce an earning?
Yeah, you can find that out manually, of course, but the tools that I use are Tom's tools, of course. They have the earnings announcements built into them. So the tools that we use know exactly when the earnings are, and they know which stocks are gapping. They know how to find those red wave patterns, those IV rush, demand curve rush patterns. So the software that we use has everything in it. All I do, I mean, I hate to dumb this down for me, but all I do is I press a button, and
Yeah,
I take.
let me add on that a little bit for everybody that's out here. Earnings can be found anywhere. You can go to finance, you can go to Yahoo Finance, you can go to Google, and you can type in a company and when their next earnings are. You could go to Earnings Whispers or Briefing.com. You can get those for each individual stock. If you go to earnings.com, and it shows you week by week what companies are coming out with earnings. What you won't get is the information that Mike has just talked about, because we have that information all put together to give us the stocks that have that 100% historical success of options climbing up into earnings. And the biggest question is, how do I get Mike? How do I get Mike, to move in? Can I get Mike to move in for a couple of months with me?
Depends where you live.
Can I have dinner with Mike every day for the next 5-6 weeks?
I like sushi.
Really, I mean, seriously though, we do have a way of doing that, because once a year we offer a program with Mike Wade, and it is the only place that you'll get this is right here with Optionetics and Tom's Trading Room, and that is the Straddle Mastery Series. It's only offered once a year, and the reason why is because, number one, Mike's too busy to do this. This is not, he doesn't do this all the time. But the biggest thing too is, and we discussed this before, this is not something you're going to find on some weekly publication anywhere. We don't put this out there because if we did, it would lose its effectiveness. There are certain things that you can publish on, like for instance, Amazon, or Apple, or QQQ, or SPY. There's several stocks out there you can publish direction. But when you start to talk about implied volatility, and too many people get their hands on that, it's gonna screw up the strategy. So we limit the strategy to our partners, ourselves, and of course we do limit it to a couple dozen new traders per year. That's it. And so you guys have the ability in here to be part of that small group, and that's something we call Straddle Mastery. Now, what I'm going to do is I'm actually going to put a link on the screen right now, but I'm going to talk about it in just a few minutes. But this is the link that you could sign up if you're one of the first or one of the only 25 people, because we're only offering this to 25 of our new traders. It's a 5-week mastery series that we do. And you can see here that we talk about what we call the breakout straddle scan. That's optimized to pick historically ideal times to enter breakout straddles. We have optimal straddle scan, which really dials down and shows you stock by stock the best entry days and the best exit days for what we call these red wave straddles, which is what Mike was teaching you a little bit of today. We talk about how to increase your return on investment by riding these red waves. And we also talk about how to delta neutralize and lock in profits by using adjustments. We're going to be putting in a bonus session. I'm going to talk about that too. It's one of the bonuses that we're going to be offering tonight. But this is a Straddle Mastery series. There's a lot more to it than just this. And what I'll do is I'll send out a PDF that shows you the details of the class. In fact, this is a good idea of what the mastery curriculum is. And we talk about this each week. We do live case studies with this each week. So it isn't just, how to straddle and strangle works, but we go into the Greeks. We go into mostly IV and what we call IV rush. All right. And we talk about this phrase we call surfing the red wave. So what is the red wave? The red wave, out of all of the implied volatility we look at in a 1 month option, in a 3 month option, in an option it's a leap option, and everything in between. The red wave is the one that generates the most return on risk in the shortest amount of time. We show you how we back test and how you can back test and identify these optimal entry and exit dates. We give you the best candidates at each single week. And so we do this week by week and get into the details of this. But this includes, what this is 5 weekly, 90 to 120 minute live online classes. And we talk about nothing but straddles, the entry rules, the exit rules, and case studies. You get 12 months of access to the recorded sessions so that you've got an entire year to go back through the library of what we teach you. There are live case studies that happen through the class. And when Mike mentions publications, let me make this clear. This is not a publication. What Mike does is he gives you the published trades that happen during these classes. We set these classes up to happen right before earnings so that you really are learning during the earnings season. All right. And so what he talks about when he says publications is he's showing you the case studies, and then he follows up with you on these case studies throughout that series. We also have a straddle scan that you're going to be getting along with this. Okay. And that straddle scan really is a 1 to 2 button click to get to to show you basically the foundation. So we're going to show you the foundations, and we're going to teach you how you look at this with a pencil and paper. But then we're going to give you the button where you can just 1 click, 2 click access to it. You get live technical support, all right, through phone, through Skype, through email, to answer any questions that you may have, other than we don't do specific trading advice. So that's the only thing you can't ask us, all right? You can also have access to Mike personally through Tom's Option Tools forum. What we do is that for our Straddle Mastery group, we will we'll get you into a forum where you can come in and talk to Mike and talk to other Straddle Mastery traders, all right, about results, about breakout scans, optimal scans, red wave scans, as well as any case studies that we discuss. All right, you have access to Mike that way through our forums. The Straddle Trapper scan. All right, so this scan is a button that you see up here, and when you click on it, you have 5 different areas you can go into. And during the 5-week course, Mike is going to talk about each of these. New for this year, we have introduced what's called the optimal call put scan, which is going to help you show you how to do this directionally. And I'll let Mike get into that when we start the class. But we have surfed the red wave. We started a new one called surfing the black wave. We talk about the difference between the two, and where you can find what we call black wave scans. We also have optimal straddle, breakout straddle, and of course our newest one, which is optimal call put. These are all part of this program, of this 5-week program. So let's talk about the bonuses we're going to do. So the first bonus, we've got a triple bonus for you here tonight. We're beginning this next week, all right? So it begins Wednesday, June 13th, and it's going to be every Wednesday for the next 5 weeks, but we're going to add a 6th live trading session, which is going to happen sometime. It could be the very next week afterwards. So we've got 6 weeks of you with Mike. And part of this in that 6 week is really going to be a review, a quick review, and then looking for trades, so that you really get this down. Because to me, repetition is key. And for me, when I was learning the first trade, I needed to learn it once, twice, 3 times, and I got it. We're going to do it 6 times and you get it. And you guys it'll be ingrained in your brain how we trade straddles. All right. Bonus 2 is, in order to use the Straddle Trader button, you got to have a subscription to our software. So we are going to give you a subscription to our Option Trader software, which allows you to go in and do so much more than just risk graph and back test options. We've got starting steps for you. We've got the crossover system that comes with that. This is for option traders, but you'll also get that straddle scan that I just showed you and all the buttons that are included in that for the rest of 2018. So you get it for the rest of the year. All right, that's going to take you through 1, 2, it'll be at least 2 cycles, and then all the option trades you can imagine in between then, to just show you how good this is. All right. Afterwards, it is a very small monthly charge if you want to continue to use Option Trader, and of course the proprietary straddle scan that is not available to anyone except people that take this class. All right. Bonus 3 is a money back guarantee. So sign up and join us for week 1. It's called Advancing the Straddle. And after the first week, if you don't believe it's as good as that we say it is, then just simply cancel by email within 72 hours and you'll be refunded a full refund, no questions asked. So the question that's on everybody's mind is, what's the cost? When you put all of this together, this is that 6-month series, the access of recorded sessions, and that's not Butterfly, it's Straddles, my mistake there. Live case studies, the Straddle Chapter scan, the partner forums, we are upgrading to Mike Wade. This, with the bonuses we're adding in, the software bonus as well, and the guarantee, we're talking about a near $4,000 program. It's that good. It really is. And there are people on this this particular session tonight that have taken Mike's class. Some have taken it more than once, and we don't do free repeats. It's that good. All right. Regular price on that's $39.95. What we're doing is we are doing a special for 25 and only 25 traders. It's $19.95. That's a 50% off price with the bonuses added in. How do you get to it? TomGentile.com/18straddles. Now this discount is going to be good for just the first 25 traders, or by Monday, June 11th. Now, when I say the first 25 traders, that's it. It's going to close up. All right. We priced it for 25 new traders only, and that's it. We're closing it up. We will not let anyone else in after that. If you are interested, you just click on or go to www.tomgentile.com/18straddles. I put it in the chat box, and I'll pop it in there again. And if you don't see it there, let me jump to a Q&A board, and let me add in, just put it in here and send to everybody for question and answer. So if you click on that, TomGentile.com/18straddles, that's going to take you to the Straddle Mastery Series page that you see here on my screen. All right. All you have to do here is you can read the information that's on here. Click on only 25 spots available. That will take you to our terms of service. Read through the terms of service. If you agree, that'll take you to the PayPal page. Now we use PayPal as our provider because they're a third party. We don't hold credit card information. We don't hold any of your information. And so, from here, what you'll do is that you can either click on PayPal and log in the way you log in, or you can simply go in and just enter in your email address. You'll enter in, I'm sorry, not your email, just enter in your card information. If you're not a PayPal subscriber, which a lot of people aren't, you can pay by debit or credit by clicking below the login area. You'll see a gray box that says log in, you pay with a debit or credit card. And you've got the special price we've already got up here. Just put your information in and then go ahead and click on pay now. 25 people only, guys. That's it. All right. Those of you that are on the live broadcast, you're getting a beginning glimpse before the folks that did not make it tonight do. This program we've done it 3 years. It's sold out every year in the last 3 years before the end of the ending date. So if you're at all interested in it, this is the time to sign up, and take advantage of the guarantee. Take advantage of the software that we're going to be giving you with this for the rest of the year. Okay. We've increased the recordings from 6 months to 12 months because we only do it once a year. So we want to make sure that during that year you have time to access those live classes again.
Hey,
And,
Tom, James wants everybody to know that there's only 24 left because he's already signed up.
Oh, I can already tell you that there's much less than that. I mean, we have a counter on this thing, and you'll get the email with the recording tonight, and you'll also see how many spots are left, and it's less than 25 now. I can guarantee you that. So, Jay, any final questions before we finish up tonight?
The biggest one is the time of the class each night. And when you give them that, just remember, like Tom reiterated, guys, they are all recorded.
Yeah, so they're all recorded, but we do the classes at 8 p.m. Eastern Standard Time because that seems to be the sweet spot for the entire world. All right. And I know somebody who is living somewhere that's saying it ain't a sweet spot for me. But
Right.
The good news is that we get that recording out to you within 1 to 2 hours after the live event. We don't wait 24, 48 hours. That recording goes out like every recording that we do here at Optionetics and Tom's Trading Room. We get that thing edited, and it's out the door as soon as possible. So you're getting it fast. All right. In fact, I venture to say that this recording will be out to you guys probably within the next hour. So you'll get it. But good question.
That wraps it.
All right. Well, I want to thank all of you guys for being part of our Tom's Trading Essentials series. I do have a bonus 4th session that's going to be coming up probably within the next month or so. We're going to get out there after earnings. But until then, guys, and I'll email you the dates. You don't have to sign up for it again since you've already signed up for this series. It's included. We're going to do week 4, but we're going to take a couple of weeks off. I'll come back with you on week 4, and we'll talk about that later. But thank you all. I'll have the recording to you soon. I'll have the slide deck to you as well. So have a great evening. I hope you enjoyed this session. I hope you found it not only educational, maybe a little bit entertaining, and I hope you also find it profitable. Thanks, everybody. We'll talk to you real soon. Have a great night.